Welcome in Rahul Chadha, who's joining us this morning, Co-Chief Investment Officer, Mirae Asset Global. Rahul, maybe you can help shed some light on what's going on. Let's talk about, the global picture first. We've got the latest testimony coming in from Powell indicating that rate cuts really are around the corner. And I guess the debate will now shift to the quantum. But let me first get your perspective on how that may play out and the likely impact. Rahul, can you hear me?
Oh, yeah. Okay. I think clearly monetary policy from Fed perspective is going to be fairly benign. And we heard, again, Chairman Powell's testimony last night. And I think one of the key factors, despite strong US job reports, was the trade war-led uncertainty, which has led to investments being put on hold globally. So it's highly likely that you have easy monetary policy from US. ECB is back to large-scale QE. BOJ is doing the same. So monetary policy is going to be benign worldwide. I think it's more a question of where growth bottoms, particularly for a country like India, and when do we see recovery happening.
So let's talk about that. That's a big concern currently, and we're seeing it play out in our markets as well. Rahul, given what we've heard in the budget, not everyone quite, enthused with the measures taken to try and stimulate growth, at least on the monetary side. What was your key takeaway? What more would you have liked to see? Because currently markets are seeming to react to a situation where they don't really see any green shoots or anything happening, let's say, for about 6 months. I'm not sure if that's your view as well.
Okay, so if you look at the budget and if you look at what government laid out in economic survey, I mean, a couple of clear positives. That the big issue with India has been the high cost of capital. So government's committed to reduce that. That happens through encouraging FDI by and getting more portfolio flows also. Some of the government borrowing done outside means you have less of a crowding out effect in the local bond market. So all these are positive from a medium term perspective. From a near term, obviously, there is a slowdown in the economy, and with government not giving any kind of consumption handouts, which are good from a medium term, the slowdown gets a bit more pronounced. So I think the way it plays out is markets may be lackluster. Some of these consumption names which have done well for last 5-7 years would take a breather, go through a bit of a price and a time correction. Whereas as government's investment spends pick up, as the big boost comes on the housing front, I think we should see the investment cycle revive.
Right. Rahul, as you said that, we've seen a slowdown, and it's evident that, there is a slowdown. Consumption earlier has not seen such a slowdown where all companies all across the board, whether it's Titan, whether it's any other company, is pointing out towards a slowdown. Does this tell you it is different this time, or, it may just last for longer before you see a pickup?
Okay. No, clearly there is going to be a slowdown, but historically what we've seen is a couple of things are necessary for an economy or a country to come out of this slowdown. One is monetary easing. So that's going to happen. We've got RBI, which has done a couple of rate cuts. We've got, again, 2 or 3 more coming over the next 12 months. So that somewhere provides support to the growth. And what also happens is if we look over the last 3-4 years, a lot of this consumption was front-ended, was a result of easy availability of consumer finance. So having exhausted that route, I think the consumer goes in a shell for 2-3 years. And after that, you will have a natural resumption of the consumption demand. So probably, again, safe to say that we saw first signs of the slowdown in August, September of 2018. It would not be before March of 2020 that you'll see consumption a pickup. In the interim, I think it's the investment-led demand which has to improve things. So from that perspective, I think if you ask me the negative in the budget, what left a lot of bitterness was the increase in taxation for people earning above 2 CR or 5 CR. Look, on one hand, government is appreciating the role, the support of high taxpayers, and then this is what they get in return. So I think that doesn't leave a good taste in mouth, because what the government's got to realize today is that unlike 20 years back, there are a lot of European countries which are offering residencies or your passports for 500,000 to €1 million. So I think the rich have an option. And we saw in Korea the Korean government made this mistake 2 years back. They went towards the socialist way, increased minimum wages, and the private investment just went on a hold. And now, after going through a pain of 2 years, the government's reversing everything. So you don't want government to make that same mistake in India, that learn it the hard way over 2 years. So I think this was something which was negative from the budget. Outside that, attracting FDI, I think, is a positive move. Again, whatever they're doing on portfolio front is clearly positive.
The surcharge on the high earners certainly left a bitter taste in the mouth of most of those FPIs. But let's get in your take as to how you've read into announcements made by the budget, on the infrastructure space in particular. Do you believe that some of the steps that have been taken in order to bolster the sector is likely to lead to a long-term up move?
No, clearly. I think first and foremost, let's look at this. The very fact that government is not giving large-scale consumption stimulus means the fiscal deficit doesn't balloon. With the infrastructure improvement which has happened over the last couple of years, with the digitization, what we'll see is growth with high productivity improvement. What it means is inflation remains low. What it means is dollar, which is kind of an appreciated against rupee by nearly 70-75% from March 2008. Remains stable, or rupee doesn't depreciate the historical levels of 4-5%. And that makes India an attractive institution in today's world when close to $13 trillion of global debt is giving negative yields. So I think that's where it lays the foundation from a long-term capital attraction. And then we need to see specific actions, whether it's the focus on railways. Look, we've seen metros get phenomenal response across cities, and we need to do it almost on a war footing because we are late in this by about 10 years. High-speed corridors need to be built up. So infrastructure is the key thing which has to be done. I think often comment one has is there's so much to do in India, and that's where one feels at times that the bandwidth is limited at a central level, basically.
Right. So, Rahul, the first signs of indication in terms of a slowdown came in from auto. Of course, you cannot, of course, auto is a part of consumption, but it's also very cyclical. Do you think the first signs of pickup will also come from auto, or it will be from the traditional FMCG companies?
I think it depends on the extent of slowdown we have in autos. If the monthly volumes are falling by 40-50%, obviously the cut is a lot more sharper. And 2-3 years later, as people realize that one needs to replace these vehicles, as people get used to the higher costs because of BS6, because of, again, the 5-year insurance, I'm sure demand revival would happen over there. I think something which I also like to talk here is of the EV policy. I think this large-scale shift, kind of emulating what's happened in China towards EV, maybe a bit out of touch with the reality, practicality, etc. And why I say that is, look, when you meet utilities like NTPC, the biggest pain point they have is the receivables from SOEs. So we're still grappling with 24/7 electricity and SOEs paying for that. So if we do EVs large scale, that's more kind of a pressure on the SOEs. And I'm not sure whether this is the right time to kind of focus on EVs, basically, because what happens is your investment spends from the auto sectors would come to a standstill over the next 2-3 years. So I think that's where somewhere the private sector investment would get impacted in the economy also.
Right. With rates coming down, do you think auto or some of these so-called between cyclical and consumption industry would benefit much more or much faster?
I think what happens is with rates coming down, the biggest beneficiary would be real estate. This is a sector which has not done anything for, let's say, last 5 years. Affordability is the best it's been. If you look at the rentals for kind of an office in India, they come to anywhere around $1.5 per square foot a month. And this is a number which is a fraction of what most businesses would pay across the region. So I think real estate benefits the most. And then again, like the way we said, some of the investment-led demand proxies would benefit. And by March, as the auto cycle kind of bottoms out, we should see revival in demand for autos also.
Okay, let's talk about financials and what you see happening there, how you feel earnings may benefit, the kind of move to support the sector, how you think that will play out, and in terms of risk-reward ratio as well, whether you see that improving.
Okay, so financials, you've got to kind of split it in two parts. One is the consumer proxies, which are some of the retail banks, which had a fairly high amount of business coming from consumption loans, call it the retail banks, NBFCs, etc. Valuations were high. Again, I think this is where you'll see slowdown. And because these names are well owned, again, what you'll see is these names correct a bit, go through a 12-month period of not doing anything. While on the other hand, corporate banks, where they've taken a lot of the asset quality pain over the last 4-5 years, and we're seeing some revival in demand, and they've got favorable LDR ratios also. The corporate banks should benefit. Outside, again, the banks, insurance look attractive. We've been increasing our weight to the space over the last 6 to 9 months. What happens is, as the free float increases in the insurance sectors, these names would find way to the benchmarks, and that's where global money would get even more interested. So insurance, particularly the life insurance names, are names which we like, both from an India country and a regional portfolio perspective.
One would say that, how would you look at the financial space? Because earlier it was only PSU and private banks, but now it's PSU, it's private banks, it's fund-based private banks, it's large corporate banks, large retail banks, insurance, MF. So, how would you diversify your portfolio within so many subsectors?
Okay, so I think, again, it depends on whether it's a very kind of a long tail portfolio or it's a concentrated portfolio. From what we are doing here is basically exposure to some of the life insurance companies, some of the corporate banks, and few retail banks which we've held from the past. So I think we're more than happy. And because some of these, either the corporate banks or the retail banks have subsidiaries which are into asset management, you kind of are covered for that.
All right, so those are the financials that we're looking at. Rahul, I know you won't speak on a specific stock, but I do want to address the corporate governance concerns raised with regards to Indigo by one of the promoters. Just in terms of, how you feel once again that may impact perception. Yes, fundamentally very sound, but, a huge issue nonetheless.
No, absolutely. Again, without commenting on a individual stock, what I'll say here is, look, it's always painful when you see companies promoted by technocrats, companies promoted by people with Ivy League background go through all these issues. And again, Indigo is one example, but we've seen with a number of other companies, whether it's healthcare sectors or other things, etc. So India is a market where investors have assumed that corporate governance standards would be much higher than rest of the Asian region. So clearly, it somewhere impacts the perception. But it's good that the red flag's been raised by one of the promoters rather than a hedge fund like the way it happens in Hong Kong, where you have a short seller reports highlighting all these issues.
I note that, while you've said there's no material shift in positioning so far, would you anticipate any such, let's say over the next quarter or so, given the softening rate environment that we're anticipating, or any other factors that you're tracking, or would you expect things to remain range bound?
Okay, so with incremental flows, we will be looking to deploy those incremental flows in rate sensitives like real estate, I said, part of corporate banks. I think telecom looks attractive. This is something you've been asking me over the last couple of quarters. And now one gets the sense that with the kind of debt Jio has, and the pressure on Reliance core business, it's highly likely that price and the consolidation in the telecom market, it's highly likely that the pricing gets more rational over the next 12 to 18 months. So I think telecom looks promising from the sectors, apart from the sectors we've discussed.
Just to probe you on telecom, Rahul, in terms of, first of all, we will still have to wait to see the 5G pricing. It looks like it's going to be super expensive once again. Pressure on the telecom giants, as was highlighted in the budget this time. Financial pressure has only gone up. We've seen, Bharti, while in terms of maybe forming a base, sure, but still struggling with the current scenario. And Idea has also been lagging. So is it just the Jio effect that you're factoring in, or is there more that makes you so bullish on telecom?
Okay, so I think what happens is this is a sector where historically we've seen pricing come down sharply. There is no issue on demand momentum. Data volumes are growing exponentially. So even if we bake in 30-40% data growth, if the pricing corrects only by about 10-15%, that's a significant revenue growth for the overall portfolio. And then you'll see the operating leverage play out. So I think that's the story one is playing. And what you want to play is with the leader in the industry. What you want to play is with the strong balance sheets. And that's where the traction is. I think the 5G capex is at least 2 or 3 years away. We've not even seen big markets like China, Korea do large scale 5G implementation. So I think India is more of a 2021-22 story.
About some of the, it's a smaller pocket, but some of the mid-cap names on the back of perhaps some consolidation, some acquisitions, in the broader kind of sense?
Okay, very selective over there. I think some space which we like is hospitals. Again, these are good businesses. They've been underperforming for last 3 to 4 years, and now as we see some of these new hospitals are breaking even, we're seeing higher occupancy for the new hospitals, and that's where operating leverage is going to play out. So I think hospitals is something we like, and some select construction names here and there.
As you said, that fiscal deficit is constrained, and I mean, it's in line with what, it's not expansionary at this point of time. Rates would be down and real estate will benefit. Do you think that will also benefit a lot of infrastructure? And again, you can divide infrastructure now into roads, rail, whatever you want to within the infrastructure pack. But do you think that's where valuations are decent, stocks have not run up, and things could be a little better, at least in the large ones?
Absolutely. I think if you take a 2-3 year view, as demand picks up, we'll see some of these operating leverage kind of pick up. And then what market trades is the relative growth momentum. So with growth slowing down in IT with a large base effect and slowing of a US economy, valuations not being cheap over there, consumer names at expensive side of valuations going through this period of time correction, everything else in market which shows an uptick in growth would attract more flows. So I think that's where some of these infrastructure names would also benefit.
So, but within infra, what would you make in terms of your checklist? So one is growth, as you mentioned, but how would you, look at the balance sheet? Because earlier companies have had issues with balance sheet, companies have had issues with approvals. What would be your other checklist apart from growth?
Okay, so again, the problem there is that you've got a handful of companies to play. So you can look at the leaders, something like a Larsen, etc. over there, or one or two smaller niche construction companies. And then one has to go to cement companies. So I think cement is something which would become a natural kind of an proxy to play the infra growth in the portfolios. I think that's the other issue one has in markets, that if you look at most of these groups which came in 90s and 2000s, they're nowhere to be seen. So that's really the problem. And that would be the key challenge for India over the next 3-4 years, that if you want to revive the investment demand, do we have the companies which can capitalize on that?
Thanks so much for joining us this morning and, sharing your views with us. Great to chat with you.